So this would be a terrible time for short-term options. But you could mention that midsummer tends to be a wonderful time.
Hey, welcome to Hedge Heads, where we discuss the commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. Well, no one knows where the market's going. We're not afraid to share some ideas. I'm Ryan Tunkseth. He's John Prishman. Well, John, I'm looking out the window. I'm thinking my backyard looks very wet today, expected to get over 2 inches of rain. There has to be planting delays going on out there. And I will point out that I pointed back in one of our first episodes in March that as soon as we got rain, we were going to have planting delay news. So that's a prediction from about 8 weeks ago. What are you seeing out there?
Well, the bad news is I'm told on Facebook, even if you got it planted, that it's probably all going to die because of this rain.
Oh, sure.
So if you're lucky enough to get it in, which I don't know who did, I think we're 0% planted according to the Facebook. But if you did get it in, you're going to have to replant. And that's the bad news. All kidding aside, we're right on pace with history. There is, or the 5-year history, there is no delays. Was there ever a story? I doubt it. It's the world we live in today with the news and commodity news, that somehow being right on pace with the planting of the 5-year average is somehow delayed. I don't know how they're able to spin it that way, but that's what we've been told, that we're looking at severe delays. We're out of the optimal windows. And then out comes Monday's report and shows us exactly on pace for corn, maybe 1% off what the 5-year average is, and then soybeans ahead of the pace. So I'm impressed by the rally, able to do that on very little news. But I think more wheat is doing the heavy lifting than anything else, and has been, believe it or not, pulling up corn and beans. And I mean, you have to go back to the Ukrainian-Russian war for that to have happened. That's pretty rare for wheat to be the leader.
I will say especially yesterday, the December wheat corn spread was quite the move. I don't know if you watched that at all, but
I do. Wheat corn spread is among my favorites. I was not smart enough to get in before this move happened, but I think that wheat was not too long ago 80 cents away from corn, and clearly it's a lot further past that now. Yeah, back to just even the wheat, you're getting headlines like, Russian shortfalls will be made up by U.S., Kansas wheat. I saw that in the headlines from a major news source yesterday. And that, that's about 10 steps away from being true. This is the same Lucy and Charlie Brown in the football, where Russia has a problem and then we instantly got all the demand by default. It does not work that way. What you want to look for in the wheat market is actual demand that would be showing up, and there's no signs of that yet. But in order to sustain this rally, that's what you would be looking for. But it is the wheat market, and it can overdo it. Everybody, is this the top? Is it done going? Wheat is a tough market because it can really overdo it when it wants to. And then it doesn't have to make sense at the time. And we saw that even with Russia, Ukraine. There was a lot of more question marks at that point, but it went way above where it needed to go. We rationed demand that we didn't need to ration, and then it got back down to 5 something. So it's nice. We're in the 7s in some of these contracts, and it's a nice change for sure. How long can we expect wheat to pull up corn and beans now that the planning progress looks like it's right on schedule? I think it's going to be hard every day. Today, wheat was really strong, but it's still a lot of heavy lifting for one market to do. So that is really what everybody's watching, the wheat market.
Yeah, I think this time of year, you tend to see a lot more bullish stories. It aligns with seasonals, right? It aligns with some confirmation bias of people who want to see prices go up. So what stories do they talk about?
Yeah, it's an odd time of year where rain is bullish, and Then one day, slowly in May, that turns from being bullish to bearish. And that's why it gets to be kind of a time of year for bulls and bears. You get your news on a daily basis. This one kind of coincided with the wheat going higher and a lot of short covering, which they were historically exceedingly short corn and beans going into a growing season. So they wrote the story with beans, I think, corn around going up with a planting delays. I think it was more the wheat moving up and just writing a story around that. But it's a time of year that I've said it many times that can surprise the guy. You know, you don't know the attitude of the market. They could easily see this weather and see it as very bearish for beans and corn, and it could be in a very bad mood. But with that tailwind from wheat, I think it helped out. And so everything rain-wise now is bullish, but it's going to turn bearish very, very soon. So if it wasn't hard enough the way it is, this time of year is that way. And it's not uncommon to find a high in grains in May at all. And then what's different between a high in May and it would be and then versus like June or July would be it's usually a volatile high in June or July, and in May it's a very quiet high, meaning that it tends to peak out one day and start leaking lower. My main problem is for all the short covering we had, what kind of rally have we really had? 50 cents in beans, 10 cents in corn. I mean, there really hasn't been a lot of movement to the upside. I was looking for more for marketing opportunities, but that's the markets we have. Today it looked a little different though. Beans and corn weak all day long today for the first time in a long time. Wheat does not want to go down, so you can't rule any of these grains out, but always an interesting time of year because you're going to find a little news for all the bulls, all the bears, and you can spin it any way you want to as long as that crop is not out of the ground. Once it shoots out of the ground, it gets to be a little more real. So human psychology plays a big part in trading this time of year.
That makes sense. So we have prices moving up or have moved up significantly, maybe pausing for a minute, tend to be bullish this time of year. What are we looking for? What opportunities are out there right now to hedge? Are there specific things you're looking at? What certain plays you're making? We've talked options. We've talked short-term, long-term. What exactly are you looking for opportunities right now?
Well, that's why I like the options this time of year because no one does know the weather. We don't know what's going to happen. That's why I like the upside open. What's really popular with guys is just doing nothing and seeing what happens and trying to catch that high. But generally, like last year, it'll be when it does go up, then the story will be more, well, we took out 640 level. Here comes $7 because my technical guru tells me there's a gap. So, it's always some excuse not to market. So, I like the options. If you think there's downside and you read this rain as bearish, because you still don't know what the growing season holds. You have your upside open, you have your downside protected. After a rally, that's what I like to look at. I can tell you it's not popular. Put options have not been popular for a while. Not here. And again, back to the news, I think it has a lot to do with the way that the news travels to people now. And you see a lot more bullish news in the mainstream stuff than you see bearish news, and they're just simply not popular, and that would explain the low implied volatility. Guys have maybe purchased calls, on the bull stories, been disappointed with the results, and they certainly don't want puts because it's below the cost of production or they don't like the price. So you just have this demand dropping in options. And that would explain why we're at this really low implied volatility. There's just not a lot of demand for this stuff. How have the phones been? Mainly, guys have been kicking the tires a little bit, but I haven't seen a lot on the hedge side of stuff, and I think that has a lot to do with just the price. They don't like where it's at. They don't feel why hedge a price that isn't profitable, and I think that's kind of what happened last year too.
I mean, I certainly get the feeling why people feel don't hedge price that's not profitable or that doesn't fit what they had planned. But what if it goes lower?
Yeah, hey, if $5 corn doesn't work for you, I hope $4 does.
Right.
It's you want to solve that problem for people and try to convince them, but they really, again, hedging is just deciding to give a counterparty your risk. And if they don't feel they have any risk here, there would be no reason to hedge. So it's more of a personal choice. So I have two camps of people, guys that are following the fundamentals and are very worried, and then everybody else who reads a lot of mainstream news, and there's a lot of bull stories out there for them. I wouldn't say they're buying calls, but calls can work very good this time of year as well, because again, the unknown on the weather. It tends to be a game of getting in before the big move and then capturing that money in a very volatile time. So it's, even if you're right, it can be a very challenging time period. And then to boot, everybody's about as busy as they get the entire year. So that's kind of the curse of hedging, is that when you're the busiest in the field is when you should be the busiest looking at your hedging. How do you solve that? Well, I find that a lot of guys find that middle ground, and they check in and see what's going on, maybe a quick text, and try to at least tune in. Those guys tend to be a little more in rhythm with the market than the guy that, had he known, let's say last year, $5 puts got to 9 cents, I think, on that spike. Had I known that, I would have done that. You hear a lot of that, and you just try to get information out as timely as you can to people. So it's a challenging time of year just because everyone's just simply so busy.
I know you're, let's start with last week. I talked a little bit about short-term options, and this time of year, especially in your front month right now, grains have 5 days. You're talking purely directional moves, purely, it's not hedging. It's more gambling. Let's say July, your favorite contract, is going to be the front month next week. But I know you like to hedge out, you're talking November at least, maybe January for beans. You're talking December, maybe March. Why?
Because it's a lot more forgiving. You can be wrong for a lot longer. For example, let's just say a 10-20 November bean put. I think I looked at the price today. It was 7 3/8 maybe, a little over $350, and that option hasn't moved probably more than 2.5 cents in the last 3 months. So it's a very forgiving. Even like the beans have gone up maybe 60 cents, and you have net $100 loss on that option. You have all that time. It's gone against you very little. And so it's very forgiving in a time of year where you need options to be very forgiving. And back to the July's just kind of a bad option because it's the last of the old crop. It's hard to know if you're going to have inversions, if they're going to stay, if they're going to go. It's hard to know what the demand is going to be that time of year. And then it misses all the major reports and all the major weather. So it has nothing that I like about it. Where you will find some success is where the old crop squeezes out, stuff like that. That doesn't look like that's going to happen this year. I just really don't like that time period. Also, September is in the middle. I don't dislike it. It can be a very good tool because often you find the lows by the third week in August, which is when September would expire. But then you'll also find lows in September, which that doesn't cover that time period. So if it's another $1 lower in September in soybeans, that's a lot of opportunity lost on hedges. So over the years, I've just gone to casting a wider net. Why not? Why try to rack your brain and figure out exactly what month and be exactly right on the right day? Why not just go fishing way out with a lot of time? That way the option can't go too low if you don't pay that much money because of all the time value. And I find it really forgiving. And you don't get emotional with it. Like you'll have this big upswing. You won't get rid of it because, that 10-20 costs 7 cents. And then all of a sudden one day it starts dropping and then you tend to stay with that market. Where if you get an expensive upfront one with some hot and dry in the news, you might get scared out of it. And then, because it's going to whip around a lot more. And then ultimately it starts raining like last year. And then you're out of your option, where the longer term stuff, the cheaper stuff I tend to stay with. And then why buy cheap longer term options? Okay, so they're not exactly a great hedging tool. Like it's not going to protect $12 like you'd buy a $12 put. why do I like a $10 November put versus a $12 put? Well, if you're trying to hedge the price, the higher option price is the truer hedge. But if you buy more of maybe a lower priced one, see, say $10, and everybody might assume, or a lot of people will assume, like, oh, this guy thinks it's going to $10. He's way too bearish. I'm not going to talk to him. It's more the vehicle. You're paying. I don't even know what a $10 put is. I'm just using it because it's a nice round number. I think it's around 5 cents. Yeah, and you could say the same thing for calls. Like, you go $2 out of the money, and your calls are going to be very cheap as well. It works both ways. I'm just using this as one specific example. It's not that you think it's going to $10. It's that you get a move quickly that direction, and what you paid 5 cents for is all of a sudden worth 20 cents. And then let's say you have 5 of them on for a total risk of $1,250 premium, and then you get a 15-cent profit times 5. That adds up pretty quick, and you don't have a lot of risk there. So that's just, in short, why I would be looking at something like that. It's just a vehicle on the direction I think the price is going to go. And certainly that you could say the same thing with calls. And they can work very good this time of year as well. And, last year was a great example of that. If you were to buy your calls in May, like this time last year, by June 10th, I think it was really starting to run up. And those cheap calls turned into really expensive calls really quick. Same concept. You paid very little for them. You got a powerful move that way. And what you paid 10 cents for, 15 cents for, all of a sudden is worth 45 cents. Now, that's all sounds easy and good. But for me personally, the hardest part by far is pulling the money out of the options, getting out of the market with the profits you see on paper. That, for me, that's by far the hardest part with cheaper options. We'll do a whole other podcast on like a higher strike price, higher priced options for use for hedging. This is just more of a tool to run in the background. Like, again, a $10 put, you think it's going to move sharp that direction in the coming months. And if it doesn't, here's the best part. Let's just say we go up $1.50 from here and you paid 5 cents for a put. That puts, you can't know the value, but it's probably going to be right around 2.5 cents. So you have 2.5 cents of risk and you were completely wrong. I mean, who doesn't love those trades where you're not right, you're not going to make money, but your losses are still very minimal. That's why I really like that stuff. I find that a lot of guys are taught the opposite. 90% of options expire worthless, and you hear all kinds of things. And I don't find too many guys that are interested in the strategy, but I find it being one of my favorites over the years. I've turned some guys onto it, and I think they've seen the light. And they don't obviously all make money, and I'm not implying that at all. It's just they're a great vehicle to participate with limited risk. That's why I like them.
Let's go back to, the two puts that you mentioned are the 10.20 and the $10. Like, that does sound bearish. It sounds like it's a put, right? To make money, you got to have it go under 10.20 then, right?
Yeah, in the end. And that's where almost every beginning conversation starts with, well, you can just tell they don't think that it's going to go there, nor do they want to if they're producing it. And thus they lose interest in that option. And again, back to it's a vehicle, and I choose more a reasonable strike price, which would be $10, and a reasonable premium. You want to find that blend, and that's your best chance. So with low implied volatility, it's and then a market that's usually chronically underpriced anyway, which would be soybeans, you'll find opportunities. We've been talking a lot about the put side, but the call side works exactly the same.
Yeah.
Like you think there's going to be adverse weather. You're buying a cheap call in this window. Maybe you'd buy November, but you only want to see the weather in June going into July. So why wouldn't you just buy a July? Back to what you said. It's tempting to do that because it fits in a box so nicely. But why I do November is because if you're not correct and beans are $11 instead of going up, what you paid maybe 8-9 cents for that call, you're probably going to still be able to get 4 or 5 cents out of it. Same sort of concept. You got to see the weather. It didn't cost you a lot of money. You'll get them next time. So that they're very forgiving that way if you get them bought right. Now, let's talk about markets where it works better in and markets that doesn't work as good.
Before you jump onto that, though, I want to talk a little bit more about these prices. Like, you're not expecting to necessarily, you mentioned taking money out of the market, that being the hard part, but you'd probably be looking to get rid of a 10-20 put or the $10 put if the market goes to 11, right? I mean, if it looks like it's going to keep down, you're going to keep on there, but those will like you said, there's no way to know. It depends on time frame. It depends
and
on
how quickly
that.
it moves. Is there news, where it looks like it could go far lower? That's why it's really hard when you're trying to teach people or talk about them. They'll want to know that. Like, when are we getting, what price will give us this price that you're saying? You can't know. If it happens slow, it's not good if you buy the option. If it happens really slow, especially if you buy out of the money. If it happens fast with news, that can be very powerful. And then what you might have been looking for a 20-cent profit on that. Maybe all of a sudden with, the tariffs, all of a sudden China retaliates and it looks like, boy, this actually is a realistic strike price that it could get to very fast. Then I tend to change my attitude, but I would have just a goal in mind. If you triple your value on a cheap option, that's what you're looking for. Just as a general rule. I mean, even double is good. You got to pay commissions, but you're just looking for that to be more than you paid for it. And what did I do last year? I had some 420 corn put spot last year, and I don't remember how much for, probably 2-3 cents. And at one point, I think there were 8-9 cents. Did not take it, and of course, they ended up being worthless. Where I had some $5 put spot correctly. At lower prices, and they were profitable almost the entire time. So that's where strike prices can be really important. But you just take it day by day. I mean, that's the truth. You get a good setup, you make a plan, use money management, and then just take it day by day and try to do the best you can in getting profits out of it. And that's where a guy really needs to concentrate is, what is my exit plan? If it's volatile, do I have a different exit plan? If it's slow, just think about it a little bit.
I would stress too that exit plan goes both ways, like profitability side and
for losses
yep. too. That we're not. I mean, you can. Maybe your exit plan is to ride it till the very end.
Yep.
Or we're going to get out when the reason we got in changes.
Yep.
Then we're going to assess and say, should we get out?
And where you'll see this a lot is in USDA reports, where let's say it's got 2 weeks left on the options, very common in front of a USDA report. You use that as a vehicle or insurance to get through the report. Let's say you have 10,000 bushels of beans and it could be a really bearish report. You buy something for 15 cents near the money. If it is a bullish report and let's just say it's up 30 cents, you try to recover as much of that 15 cents as you can, because clearly you don't have that risk anymore. So you're just using it as a short-term tool, back to your short-term options, to protect the price. You gave up 7, 8, 9 cents to see what that USDA report says. Now, you wouldn't do that every USDA report. Some have a lot of volatility historically and some don't. So you got to also know your USDA reports. I keep saying you got to know, but that's where you would lean on guys like us. Like we should know, like this one holds a lot of surprises. The just right off the bat, June is a big one, which we'll talk a lot more about. That's one of the more volatile reports of the year. And then in your fall, when you start to determine the yield, where it could be higher, it could be lower. Those are the good years, where you're going to see a violent reaction one way or the other, very volatile, because we simply don't know what the yield is. October is known for that. September can be, but October is kind of known for that report as well. So you just have to know your reports and how to use options, but very good tools to kind of, just same concept. I'm buying options to see what kind of weather we have because no one could possibly know. And, you're buying options on the USDA report because you can possibly know what the numbers are. So they're great tools when there's a lot of volatility and you don't know the answer.
Yeah. I interrupted you. You were going to talk about markets that good idea, bad idea to do some of these options. I think we could start with the difference between corn and soybeans. I'm sure you have a bigger list than that.
May's really forgiving. I mean, you got a lot of time to talk about it usually, the options, where June last year, if you called on the right day at the right minute, it made a huge difference. Like it gets to be pretty quiet, to extremely volatile in about 3 weeks from now, historically. With all this rain, though, by this time last year, we were already coming up because of the dryness. The planting was almost identical to where I think we were 76% planted last year in corn. We're 70 this year. Planting was going good, but it was so dry, and that's why. And it was already starting to be a concern. We're still getting wet right now, so we're looking at a very different pattern this year, very different look. Very hard to know what June holds, but May tends to be a little more forgiving, where you're not getting the extreme volatile moves, where June is known for those moves. Yeah. And that's where we're headed here shortly.
Yeah. Let's talk about there's a lot, every option or every market has options, right? Or every commodity. You were mentioning like there's some markets where the long-term options aren't a good idea, or short-term, or for reports, or you and I have talked about like lean hogs and crude oil, the difference between those two. Give some examples maybe of some, you
got to know your markets and your implied volatility. And that comes through experience. Crude oil at any given time with a world event can go up or down very, very, very sharply. So you have to price the options like that. The implied volatility tends to be very high. So when you're a buyer, it tends to be harder to make money. Not impossible by any stretch. It's volatile enough where it moves a lot on its own anyways. Where the corn market doesn't have that. The options tend to be expensive. Implied volatility tends to be high, and then it doesn't usually live up to that hype. So guys, and again, you can make options in corn, money and options in corn on either side, but it doesn't lend itself to hedging or trading as well as maybe soybeans. That's a grain that seems chronically underpriced option-wise, puts and calls. Implied volatility is not high enough. This year it's especially low, but it's usually not high enough. And there's usually more opportunities on just mispricing there than you'll find in the corn market. Hogs, like you mentioned, very volatile, very good market to be involved in. But then you also have to know when it's getting vastly overpriced. But if you're an option seller, that you can use that to your advantage. And then you have wheat, probably the toughest to read of all markets for implied volatility, because it can be quiet for years and then absolutely explode out of the blue and for very little reason, or go down endlessly for very little reason. It's just a market that is always mispriced or priced perfectly, and you can never know. And I think people that trade wheat know that like I wouldn't be comfortable selling a $8 call right now because it could go to $12 really easy for absolutely no reason. Other than a couple more news events pop up that get it there, where that's just not going to happen in corn. You're not going to stack 3 stories on top of corn and get it to, $3-4 run at this time of year. We'll never say never. So you have to know your markets. You have to know what markets what. S&P 500, a guy named Victor Niedenhofer. I used to read his books. He was a hedge fund guy, and I think his whole thing was selling S&P 500 puts, and he made very good returns till it didn't work anymore. But the reason why he was able to get so many good returns was that they tend to be chronically overpriced as well, because at any time the stock market could crash. So it's always those markets that can move violently with no limit that tend to be more expensive. So that's why I gravitate towards like a soybean. You have limits, it's going to move within reason, but still it usually moves more than what they're pricing in.
That makes sense. And that's, again, why it takes years to learn this stuff. Which market are you looking at? Well, which market do you want? Oats. Let's trade oats options.
Oats are excellent options as well. They're a little thin, but that's a market that'll go to sleep and then explode as well. That one's exploded a little too often here in the last few years. Yeah, we're going to need it to go to sleep again, probably for opportunity. But that's a market that that kind of gets slept on, and there's not a lot of news about it. I think that's why guys do trade it, but it's not talked about, and it's not as large a market. And of course, Canada raised most of our oats. But that's another fun one. Yeah, there's so many, and they all have their own personalities. I get a lot of questions on metal options, and they're interesting. I mean, they tend to be one of those markets that's chronically overpriced because of one day the dollar is going to be nothing and the gold is going to be a bazillion. Just that concept that could happen, tends to keep a really good bid under that stuff. Not impossible to make money at all. Just know that you're paying a premium for some of the markets that are capable of moving very fast, but rarely do.
Yeah. No, I know. I have one client that looks at sugar options quite often, and
sugar's you try to think of these markets. There's so many of them. Coffee, sugar. Sugar is a really good one because it's bear, and then all of a sudden it turns into a roaring bull. It's actually very similar to corn, really, is what it is. Whether they use the stocks up and no one really knows that until it's too late. And then when they realize it, it's like a big barge. It's hard to turn around. And once it gets going that direction, it goes fast. And so I see corn and sugar, very, very similar markets. Sugar's a little bit better because I used to do a lot more, but the calls were so cheap. And if you could catch one of those moves, you could get a lot of leverage in a market that's capable of moving very fast, but oftentimes it's very, very quiet. And of course, a lot of those calls would expire worthless.
Yeah. And that's the risk you take in any market you trade, right?
It is. It's fun that all these markets have their own personalities. And just when you get that figured out, then you gotta know what each one of them does each month that it has. First of all, the grains don't have every month where the energies have every month for the futures. So once you get a feel for the personality, then you got to figure out what month does what, in any given year. And then that changes every year as well. So it's kind of a never ending game, really.
Yeah. Well, and we talked about, started this with kind of talking long-term options, especially in soybeans, but the natural gas is another one that has options that there can be opportunity. You're rarely looking real long-term in some of those options because of long-term in natural gas is way different than long-term in soybeans.
2 days is long-term in natural gas. Yeah, that's a market. We haven't even talked about that. That can move. There was what was that website? That guy out of Florida, I believe, optionsellers.com.
Oh, yeah.
I think he was involved in natural gas options. I'm not positive. You'd have to go look that up. But that's a market that gets quiet like it is now, and then it can change abruptly as well, especially, going into winter. And then it changes a lot on the weather forecast. So that is a very interesting options market. Yes, natural gas.
Perfect. Anything else you want to add today, John? Is there anything we did not get to?
No, I mean, we have definitely listened to some of the people that have listened to podcasts, and we're going to move to more specific examples, in the real world. I think that's what guys want with options and even futures. So we're going to try to include that. And if you have a specific scenario with options or futures that you would like to hear discussed, feel free to call or email. And that's something that we plan on doing more of. And again, these aren't recommendations. These are all past things or things that are just randomly chose, like a classroom, just to go over numbers that are realistic. But it's important to learn that way. I think applying it to instead of theory, like what's actually happening in the markets, and we'll try to use specific examples of why you would do this or why you would look at this, and hopefully you find that more interesting.
Excellent. Speaking of which, do you have a hot trade for me? I got to put something on. I got nothing on right now.
Yes, I need to learn how to catch more walleyes in walleye tournaments or bigger ones.
Okay.
So if you can help me
bet
with
against John in every walleye tournament.
I don't think that bet pays very well. I bet there's too many people on that side.
Sure. Okay. Yeah. So the leverage I get on the bet on John, of course, that's going to expire worthless like my options.
Those are some serious calls that would pay one day. Had you'd be the only guy with that bet, and you're gonna be rewarded if that were to happen.
You got this garden hedged yet? I see it's still in the office. That's
Yeah, it's gonna go on the ground. It's looking great, but it's starting to. It looks like it needs to go on the ground.
I find it very interesting that the smallest plants you have are the watermelons, and the largest plants are the peas.
Yeah, I think that the watermelon are, as far as seeds go, it looks like 50-50. Half of them come up. I didn't know that, so you learn something every day. This does have to go on the ground, and I will be working on that this week, and it'll free up some space here in the front of the office, I think.
Perfect. Well, if you want to reach out to us for gardening tips, the email address is hedgeheadspod@gmail.com. We might have some option tips too. John, how do they get a hold of you?
218-731-1578.
Thanks, John.
Yep. Bye.
You always have to have a worst, so it might be the best.
Well, I think these topics are the best.
I agree with you. All right.